As widely expected, the Bank of Canada kept its key interest rate at 2.25%. Joining me now with a closer look is James Marple, senior economist with the TD Bank Group. And James, what's your reaction to the decision today?
Well, no real surprise. Everyone, I think, across the board, there wasn't a single analyst who expected a hike or a cut today, but and they didn't disappoint. The statement itself, I think, reflective of what we've seen in the economic data recently. It was rather dovish, I guess you could say. Certainly, the data has come in quite weak. GDP contracted in the fourth quarter of last year by 0.6% annualized. We just had a payroll or employment report, showed 86,000 jobs lost in February on top of 25,000 lost in January. So clearly their statement reflected that we're seeing economic weakness come through. They mentioned that the economy is in a state of excess supply, which means, you know, it could actually, all else constant, perhaps use some more help. That said, they also reflected that there's a lot of inflationary risks, especially in the aftermath of the conflict in the Middle East. We're seeing obviously upward pressure on energy prices and just a whole lot of uncertainty around a whole number of areas. So not surprising to see them on hold, but reflecting that they're going to be watching very closely the developments over the next little while.
And do you think the Bank of Canada will stay on hold for the rest of the year, or could we potentially see a hike, given that economic picture that you just described to us?
Well, I mean, hike, cut, stay on hold. I mean, anything's possible. There's just a huge cloud of uncertainty. I mean, day to day things are changing in terms of the geopolitical environment. We have the uncertainty around the CUSMA negotiations later in the year. And the economic data, even trying to translate what the shock was in terms of the tariffs. I mean, we've seen a real negative impact, especially on the auto sector and on exports to the U.S. last year. Do we see any of that rebound? Do we see investment pick up, or are we still in this real cloud of uncertainty? The other thing that's also clouding the picture is we've had population actually decline now. So the growth rate in the labor force is not what it was. All of those things, supply shocks, demand shocks, everything's happening at once. It makes for a hard environment to predict the future of monetary policy.
Well, so that's a question. How does all this uncertainty, how does that feed into monetary policy, given all the moving pieces?
Yeah, well, I mean, they're going to obviously be watching it the same as we are, even on a day-to-day basis, movements in the Middle East. Does the conflict end? Do we see a further escalation in energy prices? And then how is it coming through on the inflation side and in the job market? So on inflation, I mean, they've said they will look through a pure energy price shock. We have the advantage in Canada, at least, of being pretty close now to the 2% target. It's more elevated in the U.S. Maybe some of those risks are more acute there. And we've obviously seen the economy weaken a lot more. But we could, if it gets high enough and it stays high and you still get that, it's not a big economic negative for Canada. Obviously, oil producers benefit quite a lot. So they may have to react to that inflationary side of things. And then on the other side, again, just watching the uncertainty. Do we get an agreement on CUSMA? Do we see the labor market continue to see the unemployment rate going down, which is what it was doing late last year until the backup in February? And I'd say those are the big things they'd be watching.
And let's talk about oil prices, because they have been climbing higher. Yeah. Does that benefit at all the Canadian dollar? Or is it more limited in scope?
Yeah, I mean, we're not in the era we were, the last time we've seen a big increase in energy prices. In part, even in 2022, mind you, you didn't see a big upward thrust. And we don't see the same kind of investment that we have in the past when energy prices spike. In this environment, though, I'd say there's even less upward pressure because of the financial conditions and just the uncertainty that's being generated by the geopolitical conflict as the driver of higher energy prices. You don't typically see in that environment a lot of flight to the Canadian dollar. So, I mean, our view is that we could see a bit of an appreciation later in this year. In part, that reflects the fact that we still think, that the Fed will be cutting later in the year. That's been pushed out a little bit, but, with higher energy prices as the driver, we could see a tiny bit of upward pressure on the Canadian dollar. I think we have the year ending at 75 cents, but like everything we've talked about, a whole lot of uncertainty around that outlook.
And, given all that uncertainty, what are some of the things that's on your watch list over the next coming weeks and months as the Bank of Canada considers its its next move?
Sure. Well, I mean, obviously, the economic data, the inflation data, we'll get another important inflation report. This one, the ones we have so far before the energy shock. So seeing how much that comes through, you probably want to see a few data points. But more than that, obviously, just what's happening in the world. The geopolitical events are really overtaking everything. That includes, obviously, the conflict, but also the USMCA agreements. Do we have more tariffs come in? I mean, we have even outside of that more announcements of 301 investigations. Do we see a higher tariff rate? Or on the other hand, do they pull back given, the affordability issues and the fact that they're going into a midterm? So really, unfortunately, some of the economics is taking a back seat to just the news flow.